Welcome to the latest in the series of Mythbusters, and I'm joined by Steve Buller, who's a Portfolio Manager for the Equity Division of Fidelity Investments. Steve, thanks very much for joining us. Great to have you with us. Maybe just take a minute to explain the fund, your investment style, and also any important constraints.
I manage a variety of global and U.S. funds distributed in the U.S., Canada, and Japan for both retail and institutional clients. Now, I don't have a particular style, as in my opinion, when you operate in a sandbox, like REITs, you need to adapt to what the REIT market gives you, or, at best, what you think it will give you. At times, I've been a growth investor, a value investor, and even slightly momentum biased.
And Steve, you've obviously got extensive experience managing listed real estate investments over the past 26 years. So let's start by explaining if and how you incorporate NAV into your models. And also with that in mind, how do you ensure valuations are aligned across different geographies? Because of course there are some countries where NAV isn't as easily available.
NAV, or net asset value, is one of many valuation tools in the toolbox. If there's enough information disclosed, then I calculate my own net asset value. Very seldom do I rely on the appraisal net asset value. But I do try to harmonize across different geographies and sectors to align our NAVs. I have found net asset value analysis to be more useful in terms of a takeover of REIT, when someone will pay more for real estate in the private world than where it is trading in the public markets.
And there's been some debate about the relative merits of earnings and NAV in European listed real estate circles. So how do you view that discussion from your US perspective, Steve?
Firstly, in the US, there is no IFRS appraisal requirement, and the market has worked there very well over a long period of time. Secondly, loan-to-value covenants were a source of distress in the global financial crisis, even when interest coverages were fine. Now in the US, there are no loan-to-value covenants, which arguably led to fewer emergency equity rights offerings. And thirdly, why should the property sector be the only equity sector that requires an external appraisal of the asset side of the balance sheet?
What do you believe are some of the negative consequences of an over-reliance on NAV?
Generalist investors may not understand how the appraisal net asset value is calculated and the issues associated with this. There is always the possibility this becomes an anchor, and they may not often understand that we may be fine to buy a property stock that is actually trading above appraisal net asset value. Second, in some cases, it may actually stop M&A activity, as many boards and management teams will not permit transactions to proceed if they're done at a discount to net asset value, even if the company has never traded above or even close to net asset value. And third, appraising net asset value has a cost. It costs the REIT money, and the quality is sometimes suspect. It is supposed to be based on transactional evidence, and there are times in the market this may not even exist. There often can be lags or biases in the calculation of appraised net asset values. It often may not even fully reflect the platform value in development, funds management, and doesn't distinguish between the balance sheet differences.
In Europe, we've recently seen an uptick in rights issues frequently offered at a discount to NAV. Do you see this as a positive development? And would you expect to see more of these initiatives moving forward?
I view rights offering even at a discount favorably, but with one major caveat: as long as the company can accretively use this new equity to either buy or build properties.
And Steve, should European listed real estate companies consider more use of accelerated book builds or ABBs?
They can be quicker and cause less market disruption than a rights offering. Now, I know in many countries a rights offering is required by law, but generally I find that an ABB can effectively achieve the same result, but in one day.
Really interesting to get your take on both the net asset value discussion, but also your perspective from the US. Thanks very much for joining us, Steve.
You're welcome.
And look out for the next in the series where we'll be talking with another leading investor.